traders, Gavin McMaster here from Options Trading IQ, and today we're going to be looking at how to master volatility. Just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So volatility is a massive topic, and I could probably spend a whole week on it, but let's focus on some of the most important aspects. Volatility can refer to a few different things. Firstly, a stock has a historical volatility and an implied volatility. Historical volatility measures how much the stock has moved in the past, and that's a known thing. Implied volatility is unknown because it's the market's estimate of how volatile the stock will be in the future. We don't know this, so market makers estimate how much they think the stock will move over the next 7, 30, 60 days, etc. Volatility is high when there's a big event coming up like earnings. Once earnings have passed, volatility drops down again because the uncertainty has been removed. You can see a pretty clear example here with the chart of FedEx. We've got the stock price on the left axis, and that's the gray shaded area. And the white line is the implied volatility on the right axis. And you can see it has a pretty consistent history of rising into earnings and then a big drop as soon as that earnings announcement it has passed. So rises into earnings and then the big drop. That's also known as IV crush, which we've talked about in the past. As well as the stock having a general level of IV, every single option strike will have its own level of IV. Generally, the further out in time we go, the higher the implied volatility. This is because with more time, there's more chance that something bad can happen. This is called contango. It's a funny name. It comes from the futures market. Let's look at a couple of examples. So here we've got the VIX futures curve, the VIX term structure, you might call it, from August 2017. The black line is August 9th, and then the blue line is the next day on August 10th. What we're looking at here on the black line is contango. The short-term options, 0 days to 30 days, have low volatility. The further out in time we go, the higher the volatility. Now, the next day, the S&P 500 dropped around 2%, and we saw a big shift in the volatility term structure. We saw that it went into the opposite of contango, just slightly, which is called backwardation, where we've got higher values in the short-term options, and then it drops as we go further out in time, and then it gets back into contango later on. So very slight backwardation here. The other thing that's really important to notice with this graphic is when there's a volatility spike, it always impacts the short-term options the most. Notice how there's a big gap between the days from the 9th to the 10th in those short-term options. When we go further out in the curve out to 90, 120 days, the gap isn't nearly as big. So the biggest spike in volatility happened in those short-term options, those daily and weekly options. And that's a really important concept to understand, because if we're selling options and we're selling daily credit spreads or condors or cash secured puts or weekly trades, those are the ones that are going to be adversely impacted when there's a volatility spike. So a very important concept to understand. Let's look at another example. So this is even more extreme. This is from February 2018, which is a day known as the Volpocalypse or Volmageddon, when the VIX jumped by about 115%. It was the biggest spike in recorded history. So we can see here the black line, we actually had slight contango on February the 2nd, and then we had, slight backwardation. And then the next day we had massive backwardation, very high volatility in the short-term options. And as we go further out in time, the volatility drops down. It still has risen, but it's not risen by as much. And it's certainly lower than the short-term volatility. A lot of times when we get a volatility spike, what this is showing us is, yes, there's a vol spike at the moment, but we think that's going to settle down in the future. And that generally happens. The volatility spikes generally don't last for too long. Now, I also have a favorite saying in the market, and that is bad things happen in backwardation. And if you go back through history, pretty much every single major market collapse, flash crash, Black Monday, whatever, Black Friday, they all happened after the market went into backwardation. So that's why it pays to keep an eye on this term structure of volatility. You can do that for free at vixcentral.com. It's a really good resource. You typically don't need to check it every day, particularly if the market's calm and we're in a bullish market. You don't really need to check it too often. But if we start to go into a correction, stocks start selling off, that's when I would be sort of checking that every day. And if that goes into backwardation, that's a signal to me to reduce risk, maybe close out some positions, add some hedge trades, things like that. So just remember that bad things happen in backwardation. As well as volatility being different through time, which is what we've been looking at, that's called horizontal skew, it can also be different across the strikes, so vertical skew, so up and down the option chain. Generally, implied volatility is high for far out of the money puts because people are willing to pay more for crash protection. This is especially true for the Russell 2000 index, which tends to fall severely during market corrections. So here what we're looking at is the implied volatility skew for IWM, the ETF on the Russell 2000 index. I think at the time IWM was trading around here, 185. You can see as we go further out down in price, the higher the implied volatility goes. So we can take advantage of this as option sellers by selling these out of the money puts, which are relatively more expensive than the closer to the money puts. So that's vertical skew when we're going up and down through the option chain within the 1 month, and horizontal skew is when we're going across the option chain across different months, different time periods, and that's where we get our contango and backwardation. So two different types of volatility skew. Out of the money puts having high volatility is not always the case. Here we can see Tesla volatility, which is skewed to the upside. This is because traders were aggressively buying out of the money calls to try and profit from the rising stock price. So this was a few years ago when Tesla was in the midst of its massive bullish run. The stock was around here, mid 500s or low 500s, and you can see the out of the money calls were trading at very, very high volatility because there was a lot of rampant speculation going on in Tesla. Mastering volatility is essential for successful options trading. By understanding its nuances, traders can make informed decisions and adapt their strategies to different market conditions. Remember to use the right tools and indicators and always be cautious of common pitfalls. With a solid grasp of implied volatility, traders can navigate the options market with confidence and increase their chances of success. Keep learning and refining your skills to stay ahead in the ever-changing world of options trading. Thanks for watching and have a great day.